Gold sits near historic highs in early 2026, trading in a range that would have seemed almost unthinkable just 5 years ago. The yellow metal, that ancient store of value, that hedge against chaos and inflation, has delivered extraordinary returns for those who positioned themselves correctly over the past decade. But here's what's curious. As gold approaches the $500 per ounce threshold, a pattern has emerged in institutional portfolio adjustments that raises a fundamental question about the future of precious metals investing. Large asset managers, sovereign wealth funds, and family offices, the entities we collectively call smart money, aren't abandoning precious metals. But they are rebalancing. They're reducing gold allocations in favor of another metal, not dramatically, not in a way that creates headlines, but consistently, methodically, and with clear strategic intent. This isn't about gold losing its fundamental appeal. It's about something more nuanced, something that tells us about where we are in the current economic cycle and what these sophisticated investors see coming next. The question we need to examine isn't whether gold remains valuable. It does. The question is whether gold at current valuations represents the optimal precious metals allocation for the years ahead, or whether the risk-reward profile has shifted in favor of alternatives that offer different exposure to the same macroeconomic forces that drove gold higher in the first place. To answer that question, we need to understand what's actually happening in precious metals markets right now, why institutional money is moving, and what this rotation tells us about the economic environment we're entering. Let's establish the baseline. Gold's ascent to current levels near $5,100 per ounce didn't happen overnight, and it wasn't driven by speculation alone. This has been a fundamental repricing of monetary metals in response to a decade of extraordinary central bank policy, escalating geopolitical tensions, and a gradual loss of confidence in fiat currency stability. In January 2020, just before the pandemic disrupted global markets, gold traded around $350 per ounce. That provides our historical reference point. Over the following years, as the Federal Reserve and other central banks expanded their balance sheets by trillions of dollars, as government debt levels surged past 120% of GDP in the United States, and as inflation returned with force in 2021 and 2022, gold began its climb. That's a remarkable run by any measure. From that January 2020 baseline of approximately $1,150, gold has more than tripled. Investors who maintained meaningful gold positions through this period have been handsomely rewarded. The metal fulfilled exactly the role its advocates promised: protection against monetary debasement, a hedge against geopolitical instability, and a store of value when confidence in traditional financial assets wavered. But here's what's important to understand about markets and valuations. Assets don't move in straight lines forever. When something has tripled in 5 to 6 years, when it's achieved widespread acceptance, when every financial advisor includes it in recommended portfolios, the risk-reward equation changes. This doesn't mean the asset will crash. Gold probably won't crash. But it does mean that forward returns may not match backward returns. And it means that opportunity cost becomes a critical consideration. Current data from early 2026 shows gold continuing to trade in a relatively tight range between $4,900 and $5,200 per ounce. The volatility has actually decreased compared to 2024 and early 2025. Trading volumes remain healthy, but not exceptional. Open interest in futures markets is elevated but stable. What we're seeing is a mature bull market, one that has achieved broad recognition, one that has largely priced in the concerns that drove it higher. This is the context in which institutional rebalancing is occurring. The rotation away from gold toward other precious metals is not showing up in dramatic fashion in the headlines, but it's visible in the data if you know where to look. Exchange-traded fund flows provide one window into this shift. Throughout 2024, gold ETFs saw consistent inflows as both retail and institutional investors added exposure. But in the fourth quarter of 2025 and into early 2026, those inflows have moderated substantially. We're not seeing massive outflows, but we're seeing a deceleration in new money entering gold-focused vehicles. Meanwhile, ETFs focused on silver and platinum have experienced a notable pickup in institutional interest. The change isn't sudden, but it's persistent. Asset managers are trimming gold positions from perhaps 8% or 10% of a precious metals allocation down to 5% or 6%, and redirecting that capital into metals that offer different risk profiles and different drivers of demand. Why would sophisticated investors reduce exposure to an asset that has performed so well? The answer lies in how institutional portfolios are actually managed. Professional asset allocators don't simply buy what's worked and hold it forever. They constantly evaluate forward-looking risk and return. They ask whether current prices already reflect the positive factors they're concerned about. They look for asymmetry, for situations where potential upside exceeds potential downside by a meaningful margin. At gold's current valuation near $5 to $100, many institutional investors believe the metal has largely priced in the monetary and geopolitical concerns that drove its rally. They're not bearish on gold. They simply view it as fairly valued or even somewhat expensive relative to historical norms and relative to the other opportunities available within the precious metals complex. This is a crucial distinction. Fair value doesn't mean sell everything. It means reduce exposure to optimal levels and look for better risk-adjusted opportunities elsewhere. The shift is also visible in the derivatives markets. Options activity on gold has shown increasing interest in strategies that profit from range-bound trading rather than continued upside. Covered call strategies, where investors own gold but sell call options against their positions, have become increasingly popular. This tells us that holders of gold expect the metal to move sideways or up modestly, but they're willing to cap their upside in exchange for premium income. That's not the positioning of investors who expect another doubling from here. So where is this institutional money going? The primary beneficiary of gold reallocation has been silver. The white metal, which is historically traded as both a precious metal and an industrial metal, offers exposure to many of the same macroeconomic factors that support gold, but with additional drivers that may provide superior returns from current levels. Silver currently trades around $32 to $34 per ounce in early 2026, depending on daily fluctuations. That's substantially higher than the metal's historical average, but it's also well below its inflation-adjusted all-time high. In January 1980, at the peak of the Hunt Brothers silver squeeze, silver briefly touched $50 per ounce. In nominal terms, silver today is about 35% below that level. But adjusted for inflation over more than 4 decades, the 1980 peak would represent approximately $185 in today's dollars. Even the 2011 peak of roughly $48 per ounce would equal about $65 in 2026 dollars after adjusting for inflation. This historical context matters because it illustrates that silver, unlike gold, hasn't yet reached valuations that fully reflect its monetary metal status or its industrial importance. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, currently sits around 150 to 1. Historically, that ratio has averaged closer to 60 to 1, and during periods of precious metal strength, it's often compressed to 40 to 1 or even lower. If silver were to revert toward historical ratio norms while gold holds near $5 to $100, silver would need to trade between $85 and $127 per ounce. That represents potential upside of 150% to 275% from current levels. Now, we need to be clear about something important. Historical ratios are not guarantees of future performance. Markets can remain out of balance for extended periods. The gold to silver ratio could stay elevated for years or even widen further. There are structural reasons why silver might trade at a higher ratio than in the past, including changes in industrial demand patterns and the different roles the metals play in modern portfolios. But the point is that silver offers substantially more upside potential than gold does from current prices, assuming both metals benefit from the same macroeconomic tailwinds. Beyond the monetary metal argument, silver has something gold lacks: significant industrial demand. Approximately 50% of silver consumption comes from industrial applications. The metal is essential in solar panel production, where it's used in photovoltaic cells. It's critical in electronics manufacturing due to its superior conductivity. It's increasingly important in electric vehicle production and in 5G infrastructure. As the global economy continues its transition toward renewable energy and advanced electronics, industrial silver demand is projected to grow substantially over the coming decade. Recent data from 2025 shows global silver mine production at approximately 840 million ounces annually, while total demand, combining industrial, investment, and jewelry use, exceeds 1.1 billion ounces. This structural deficit means that above-ground inventories are being drawn down to meet current consumption. Unlike gold, where annual mine production roughly equals jewelry and investment demand with central banks providing the marginal buyer, silver faces a supply squeeze that could drive prices significantly higher if investment demand accelerates. The other metal receiving increased institutional attention is platinum. This is perhaps more surprising than the silver rotation because platinum has badly underperformed gold over the past decade. In January 2020, platinum traded around $980 per ounce, actually higher than gold at that time, relative to historical norms. Today, platinum trades near $950 to $1,000 per ounce. While gold has tripled, platinum has gone essentially nowhere. For value-oriented institutional investors, this underperformance creates opportunity. Platinum is rarer than gold, with annual mine production of only about 6 million ounces compared to roughly 100 million ounces for gold. Historically, platinum traded at a significant premium to gold, reflecting its scarcity and industrial importance. The fact that platinum now trades at approximately 1/125th the price of gold represents a historic anomaly. Why has platinum lagged so dramatically? The primary reason is diesel. Platinum's largest industrial use has traditionally been in catalytic converters for diesel engines. As diesel fell out of favor in passenger vehicles, particularly in Europe, following the Volkswagen emissions scandal and subsequent regulatory crackdowns, platinum demand suffered. The automotive industry shifted toward gasoline engines and electric vehicles, both of which reduced platinum consumption. But here's what's changing. The hydrogen economy, which has been discussed for years but is finally beginning to materialize in meaningful scale, uses platinum as a critical catalyst in fuel cells. Green hydrogen production, which electrolyzes water using renewable energy, requires platinum group metals in the electrolysis process. As governments globally commit to hydrogen infrastructure as part of their net zero carbon goals, platinum demand from this sector is expected to grow substantially. Additionally, the jewelry market in China, which represents the world's largest consumer market for precious metals, has shown increasing preference for platinum. Cultural factors and marketing campaigns have positioned platinum as a premium alternative to gold for wedding jewelry and luxury items. This demand has been growing steadily over the past several years and shows no signs of slowing. From a supply perspective, platinum faces challenges similar to silver. Approximately 70% of global platinum production comes from South Africa, where mining operations face ongoing challenges including power shortages, labor disputes, and declining ore grades. Mine supply has been stagnant or declining in recent years, even as prices have remained relatively subdued. This suggests that at current prices, platinum mining is barely economic, setting up potential for supply deficits if demand increases. Institutional investors looking at platinum see a metal that's fundamentally mispriced relative to its scarcity, relative to gold, and relative to its emerging industrial applications. The risk reward at $950 per ounce looks substantially more attractive than gold at $5,200, even accounting for the different demand drivers and market structures. If platinum simply reverts to its historical discount to gold of around 10% to 20%, rather than the current 80% discount, the metal could trade between $4,000 and $4,500 per ounce, representing potential returns of 350% to 375%. Now, we need to examine the counter-arguments, because responsible analysis requires presenting the risks and uncertainties that could invalidate this rotation thesis. There are several substantial reasons why institutional investors might be wrong to reduce gold exposure in favor of silver and platinum. First, gold's role as the ultimate monetary metal remains unchallenged. Central banks hold gold, not silver or platinum. When systemic financial stress emerges, when currencies face devaluation pressure, when geopolitical tensions escalate toward conflict, capital flows to gold. It's the most liquid precious metal market by far. It has thousands of years of history as money. It has no industrial use risk, no exposure to economic cycles, no dependence on technological adoption. Gold is pure monetary metal, and that purity has value. If we enter a period of severe financial instability, something worse than what we've experienced over the past 5 years, gold may continue to outperform precisely because it's already expensive. Markets in crisis don't care about valuation. They care about safety and liquidity. Gold provides both in unparalleled measure. An investor who rotates from gold to silver at current levels might find themselves holding a metal that declines in value during the very scenario they're trying to hedge against. Second, the industrial demand story for silver and platinum carries execution risk. Solar panel manufacturers are constantly working to reduce silver content per panel to lower costs. Technological improvements could substantially reduce silver intensity in photovoltaics over the next 5 years. Similarly, the hydrogen economy might not develop as quickly as proponents expect. Government subsidies could be reduced. Technological alternatives to platinum catalysts could emerge. Industrial demand projections are inherently uncertain and subject to change based on factors outside the control of precious metals investors. Third, the supply deficit narrative requires continued or increasing investment demand to drive prices higher. If investment demand for silver weakens, if ETF outflows exceed industrial demand growth, prices could stagnate or decline despite structural deficits. Markets can remain oversupplied or undersupplied for extended periods without prices adjusting, particularly in commodities where production decisions lag price signals by years. Fourth, there's the timing risk. Even if silver and platinum are fundamentally undervalued relative to gold, that mispricing could persist for years. The gold to silver ratio has been above 80-1 for most of the past decade. It could easily remain elevated for several more years. An investor who rotates from gold to silver today might watch gold continue to outperform for the next 24 to 36 months, even if silver eventually catches up over a 5 or 10-year horizon. Opportunity cost is real, and being early in markets can be indistinguishable from being wrong. Fifth, regulatory and geopolitical factors could favor gold over alternatives. If governments decide to implement windfall taxes on mining companies, if trade restrictions limit metal flows, if environmental regulations make new mine development prohibitively expensive, the metals most affected might not be the ones investors expect. Gold's established infrastructure and broad acceptance might protect it from regulatory headwinds that could impact smaller, more concentrated markets like platinum. These aren't trivial concerns. They represent real risks that institutional investors must weigh when deciding whether to rotate precious metals allocations. The fact that smart money is moving doesn't mean smart money is correct. Markets are humbling, and even sophisticated investors make mistakes, particularly when they extrapolate recent trends too aggressively into the future. To properly evaluate whether the institutional rotation makes sense, we need to understand the broader macroeconomic environment in which this is occurring. Precious metals don't exist in a vacuum. Their prices and relative performance depend on the interplay of monetary policy, inflation expectations, real interest rates, currency movements, and geopolitical stability. As of early 2026, several key macro factors support continued strength in precious metals broadly, though they affect individual metals differently. U.S. government debt now exceeds $36 trillion, with debt to GDP ratios above 120%. Deficit spending continues at approximately $1.5 trillion to $2 trillion annually, with no realistic political path toward meaningful fiscal consolidation. This creates ongoing pressure on the dollar's long-term purchasing power and supports the monetary metal narrative for both gold and silver. Interest rates, after peaking above 5% in 2023 and 2024, have moderated as inflation cooled from its 2022 highs. The Federal Reserve currently maintains policy rates in the range of 3.5% to 4%, a level that historically has been consistent with positive real returns on Treasury securities. However, if inflation remains structurally elevated in the 2.5% to 3.5% range, as many economists now expect, real interest rates remain barely positive or even negative depending on which inflation measure you use. This environment of low or negative real rates has historically been favorable for precious metals. Global central banks continue to diversify reserves away from dollar-denominated assets, particularly in emerging markets, and among countries seeking to reduce exposure to U.S. geopolitical influence. China, Russia, India, Turkey, and numerous other nations have been net buyers of gold in recent years, with 2024 and 2025 showing record levels of central bank gold purchases. This institutional bid from sovereign entities provides a floor under gold prices, but it's specific to gold. Central banks don't buy silver or platinum for reserves, which means those metals lack this particular support, but also lack this particular source of demand that might be fully reflected in current prices. The U.S. dollar index, which measures the greenback against a basket of major currencies, has remained relatively strong despite concerns about fiscal sustainability, trading near levels seen in 2023 and 2024. This dollar strength has, if anything, restrained precious metals prices from moving even higher. If the dollar were to weaken substantially from current levels, as could occur if foreign central banks accelerate their diversification efforts, or if U.S. fiscal concerns intensify, precious metals prices in dollar terms would likely surge across the board. Geopolitical tensions remain elevated in early 2026. Ongoing conflicts, tensions between major powers, uncertainty around trade policies, and the general fragmentation of the post-Cold War global order all contribute to demand for safe haven assets. Gold benefits most directly from this dynamic, but silver and platinum also benefit to the extent that geopolitical instability drives broader commodity demand or creates supply disruptions in concentrated production regions like South Africa. From an industrial demand perspective, the global economy in 2026 shows mixed signals. Growth has been modest in developed markets, stronger in emerging Asia, and challenged in Europe. The transition toward renewable energy continues, supported by government mandates and subsidies, which benefits silver demand in solar and platinum demand in hydrogen. Electric vehicle adoption continues to grow, though at a somewhat slower pace than the most optimistic forecasts from several years ago. Electronics demand remains robust, supporting silver consumption in devices and infrastructure. Given everything we've examined, how should investors think about precious metals allocation in early 2026? The institutional approach offers some guidance, though individual circumstances and risk tolerances vary substantially. The starting point is recognizing that precious metals serve a specific role in diversified portfolios. They're not growth assets. They don't generate cash flow. They're insurance against monetary instability and portfolio hedges against scenarios where traditional financial assets struggle. The question isn't whether to own precious metals, but rather which metals to own and in what proportion. At current valuations, institutional investors are generally maintaining total precious metals allocations, but shifting the composition. Instead of holding 100% gold, many are moving toward a blend that might be 50% gold, 35% silver and 15% platinum, or similar variations depending on their specific outlook and risk tolerance. The logic is straightforward. Maintain core exposure to the ultimate monetary metal in gold, but increase allocation to metals that offer greater upside potential if the precious metals bull market continues. For more aggressive investors, the allocation might tilt even more heavily towards silver and platinum, perhaps 30% gold, 50% silver, and 20% platinum. The trade-off is clear. More potential upside, but also more volatility and more dependence on industrial demand factors that could disappoint. For conservative investors, gold might remain the dominant holding at 70% to 80%, with modest silver and platinum positions added primarily for diversification rather than outsized return potential. Physical ownership versus financial instruments is another consideration. Gold's liquidity and established infrastructure make it relatively straightforward to own through ETFs, closed-end funds, or physical bullion stored in allocated accounts. Silver and platinum can be owned the same way, though spreads between buy and sell prices tend to be wider, and storage costs for equivalent dollar values are higher due to the metal's lower value per ounce. For larger allocations, financial instruments generally make more sense than physical ownership, though some investors prefer the tangibility and security of physical metal regardless of the costs. Timing the rotation is impossible with precision, but the institutional approach suggests a gradual rebalancing rather than dramatic shifts. An investor overweighted in gold might reduce their position by 10% to 20% and redeploy that capital into silver or platinum, then reassess after 6 to 12 months, based on how prices and fundamentals have evolved. This measured approach reduces the risk of mistiming markets while still positioning for the rotation thesis to play out. It's also worth considering the time horizon. The rotation from gold to other precious metals makes most sense for investors with at least a 3 to 5 year time horizon. Over shorter periods, gold's superior liquidity and established role as the premier safe haven makes it the better choice for most investors. Over longer periods, the valuation discount and demand growth potential of silver and platinum become more relevant and more likely to drive outperformance. Tax considerations matter as well, particularly in the United States, where precious metals are taxed as collectibles with a maximum federal rate of 28% on long-term capital gains, rather than the more favorable 15% or 20% rates that apply to stocks and bonds. This tax treatment makes precious metals less attractive in taxable accounts and more suitable for tax-advantaged retirement accounts where the tax drag can be deferred or eliminated. Gold's rise to near $500 per ounce represents one of the great bull markets in modern financial history. The metal has fulfilled its promise as a store of value and hedge against monetary instability. Investors who positioned themselves in gold over the past 5 to 6 years have been rewarded handsomely. But markets are forward-looking, and the question that matters now is what happens next. The institutional rotation from gold towards silver and platinum tells us something important about how sophisticated investors view risk and reward at current price levels. They're not abandoning precious metals. They're not bearish on the fundamental factors driving monetary metals higher. They're making a calculated judgment that gold at $5,100 has largely priced in the concerns they're hedging against, while silver at $32 and platinum at $950 offer more attractive risk-adjusted return potential. Whether this rotation proves prescient or premature won't be clear for years. If we experience severe financial crisis or geopolitical catastrophe, gold's role as the ultimate safe haven may drive continued outperformance regardless of valuation. If the global economy stabilizes and industrial demand drives metals prices, silver and platinum may justify the institutional shift. If inflation proves more persistent than expected and central banks remain behind the curve, all precious metals may move higher together, with the valuation discounts in silver and platinum allowing them to outperform. What's clear is that precious metals as an asset class remain relevant in early 2026. The fundamental drivers that pushed gold higher, fiscal imbalances, monetary instability, geopolitical tensions, currency debasement concerns, haven't disappeared. If anything, many have intensified. The debt to GDP ratios are higher, the political polarization is deeper, the geopolitical fragmentation is more pronounced. These factors support continued institutional and individual interest in monetary metals as portfolio hedges and insurance policies. The specific question of whether to hold gold or rotate towards silver and platinum comes down to individual assessment of risk tolerance, time horizon, and conviction about the future economic environment. Gold offers safety and liquidity, but limited upside from current levels. Silver offers substantial potential upside, but greater volatility and dependence on industrial demand. Platinum offers even more dramatic upside potential if its historical relationship to gold reasserts itself, but also carries meaningful risk from concentrated production and uncertain hydrogen economy development. The institutional approach of maintaining precious metals exposure while rebalancing composition represents a middle path that acknowledges both the continued relevance of monetary metals and the valuation realities after gold's extraordinary run. For most investors, some allocation to precious metals makes sense as portfolio insurance. The debate is simply about which metals offer the best combination of protection and return potential from current starting points. As we move through 2026 and beyond, several catalysts could accelerate or reverse the trends we've examined. A recession would likely benefit all precious metals, but particularly gold as the flight to safety trade intensifies. Accelerating inflation would support silver and platinum through industrial demand, while also benefiting gold. A dollar collapse would drive all precious metals sharply higher in dollar terms. Technological breakthroughs that reduce industrial consumption of silver or platinum could undermine the rotation thesis entirely. The complexity of these interacting factors means that no allocation strategy is perfect or without risk. What the institutional rotation tells us is simply that at current price levels, sophisticated investors with long time horizons see better risk-adjusted opportunities in the metals that have lagged rather than the metal that has already tripled. Whether that judgment proves correct will depend on factors that remain uncertain, scenarios that haven't yet unfolded, and market dynamics that continue to evolve. The best any investor can do is understand the factors at play, assess their own circumstances and risk tolerance, and position accordingly with humility about the limits of foresight in complex adaptive systems like global financial markets.